Hello traders, Gary Wagner here, approximately 11 a.m. in Honolulu. It is the first day of December, Thursday, and this is the daily report for gold and silver. We have the precious metals markets under pressure today, giving back a modest amount of the gains we saw yesterday. We are currently looking at cash gold trading 1744, 1743 in that area. It did come down intraday and made a low, I believe it was 1733. And the interesting thing about that number is, let me go ahead and bring up this chart. What we have here in essence is a single Fibonacci retracement going from the beginning of this rally, and this is at the end of November, roughly at 1667, all the way up to 1753. Now, a 23% retracement of that move up takes you to 1733, and that also exactly matches the intraday low that we've seen in gold. It bodes well for the bull side because in a bullish retracement, in other words, when the market's correcting after a strong rally, if it only gives back 23% as opposed to 38% or a 50% retracement, it is showing you good strength in this rally. Traders, this is that same gold chart, the 480-minute candlestick chart, but I've shrunk it down so that we can take a look at the current count and kind of expand on what we talked about yesterday. And that is that it is my current belief that we are most likely in an impulse phase, and we are most likely currently right in the middle of wave 3 of 5. So one of the ways that we can absolutely look to forecast what kind of potential price move we may see is one of the guidelines with Elliott Wave is that wave 3 cannot be the shortest or smallest of the 3 impulse waves. So we're simply looking at the price move that we saw in wave 1, and we will take it and move it towards this wave 3. And as you can see, at minimum, we've already exceeded that. But at minimum, it would have had to move from this low of around 1600 to about 1750. It's about $150 on that particular wave. However, it's more typical that you'll see a wave 3 that is anywhere between 1.61 to 2.23 in terms of the percentage. And that would carry it a little bit higher. So traders, what I've done is this line here represents a price move equal to 1.5 times the price move we saw in the first wave, wave 1. That would carry us up to about 1850. Now, let's assume that this market does go to 1850 and we then get a classic retracement. The retracement that we would probably be looking at, once again, is going to be anywhere between 50 and 75% of the prior move. So what would be possible then is that if the market, in fact, did go to 1851 and retraced, it would probably retrace. This is a 50%. Let me see if I can go in and line that up, which would be right around here, or 1733, and then we would have one final impulse wave, wave 5. Now, if we get a fifth wave that is close to equal to wave 3, let's think about it. We had a $1,600 to 1850 move, $250, market comes down 50%, lands at 1750, and then from 1750 moves back up $250. The magic number becomes $2,000 gold. And to me, that is quite remarkable, but I believe that it is not only quite possible, but inevitable within the gold market itself. Now, traders, as you know, we did put out a buy recommendation yesterday and also a buy or add to that core position today. That's both in gold. We put out a soft buy signal in silver, but that with a major caveat. And the caveat is having silver begin to trade and close above what I consider to be absolutely critical ground, which is the 61% retracement, 32.90. As you can see, we're back down to about 32.74. And my best sentiment is to buy this breakout, but buy it as it goes through that price. Because as long as we see any kind of real resistance, as we did right here or here, this market does not have the opportunity to really even go and try to challenge this resistance area, which proved to be absolutely formidable, and it was one that silver was unable to take out at $35 per ounce. Now, let's make a bold assumption, and let's assume that the market does rally and begins to move not only past the 32.90, but begins to go and trades above 35. Our next targets, of course, is, call it 38, it's 37.83, and then $40.50, somewhere around there. I think that these are our achievable targets. If we get gold rallying to 2,000, I think you will see silver go back to about $40 plus per ounce. The only other market that I really want to look at today, because it is so important when we look at the price of gold and silver, and that is the dollar index. Of course, the dollar has been weakening ever since the central banks in unison worked with the Federal Reserve to really create mass liquidity to lend to various central banks at very, very cheap rates, so that they in turn can put that money out into the system. Now you can see this is our weekly chart, 78.39. It's been solid red and solid down. You can see the absolute resistance it hit right at about 80. There's going to be two levels that we'll want to look at in terms of support. If the market continues to trade lower, I really think that the first level of support that it's going to need to break is going to be roughly around 77. It's based upon these tops in here. As you can see, when the market gaps, this is where we have a lot of open and closing activity. So it kind of follows through there. And I think that personally, the dollar could go as low as 77. But I think that against the euro dollar in particular, we will begin to witness a euro dollar spread that goes closer and closer to parity. This has been Gary Wagner, wishing you, as always, good trading, and we'll talk to you tomorrow for the weekly review and wrap-up. Bye-bye.